Yes, I think at the margin you can buy bonds, but don't forget that we'll probably see higher yield between now and the end of the year. So if you buy bonds in the US because they have suffered quite rapidly in this part of the year, I would do it at the intermediate part of the curve. For a specific reason, I suspect that the new Fed leadership would be more tolerant on inflation, and that should mean that they are a little slower than currently expected in raising rates. That should favor at the margin the short end of the curve and maybe penalize the long end of the curve. So I would start buying bonds, but only at the short end of the curve of the US. I think the Italian situation is very complicated. It's the only country that has produced two anti-establishment parties, and obviously this is making the formation of a government compatible with the international environment much more complicated. The two parties are, one of them is anti-Euro by nature, the other one is anti-fiscal discipline. So obviously producing a viable solution within the European institution is not going to be an easy task. We are now in the process of seeing maybe a prime minister who should be more moderate than the two parties would suggest, but I think we'll undergo more volatility, and I'm not even convinced that the solution will be found easily in the next hours. We've been short on both bonds and equities, and only coming from this position, so being betting against them, we have started to buy some bonds. This is because bonds have reached very rapidly what we believe is a kind of fair value, 180 basis points relative to bonds in the yield to maturity of Italian government bonds is quite reasonable in light of the credit stance of the country. So you can buy it until you put at risk the EMU belonging of Italy. So the minute you start discussing exiting EMU, that becomes, of course, no longer true. But for the time being, I think this can be done. It's a very tactical move, though. I think there is, as I said before, more volatility to be expected on both BTPs and stock exchange. It's a big question. You've got to be selective. I suspect, especially Latin America, is not enjoying a positive environment when you have the dollar rising. Not by chance, Argentina has gone, of course, under huge pressure. So, in a way, the strong dollar environment with the rising U.S. rates is not very conducive to these countries, but that has not much to do with the trust in their countries, in these countries. It's simply that it is a less valuable environment for investing in their fixed income parts. So I think there is a little more pain to go, but eventually we'll go back and invest in these countries, starting from the equity side, though, not fixed income, only later on their fixed income markets. We are long energy in equity investment, so yes, we believe that they have underperformed for long in the past quarters, and they still have room to recover, even though I'm not convinced that the oil price will go much higher than where we are now, because there is, yes, some geopolitical elements supporting it, which eventually will fade. But then, given the rapidity with which the new production can be put in the market, and referring specifically to shale oil, usually production, so the offer side, adjusts quite quickly to the new price levels. So I don't believe we'll have a strong overshooting relative to the break-even level of the new productions. That break-even level has to be in the region of between 50 and 70. So you see, I am convinced that oil companies now do offer value because they were undervalued. Not necessarily I would buy them because of the oil price.